The Doc is pleased to announce the launch of thenewsdoctors.com, a new website dedicated to providing 24/7 access to breaking news worldwide, from sources including Zero Hedge, RT News, Silver Doctors, and exclusive articles from the Doc and Eric Dubin. Thenewsdoctors.com, changing the way you view news.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets. Well, we had another big Friday in the metals with both gold and silver jumping up quite a bit on the day, 4% in silver, just under 2% in gold, on the heels of another terrible home sales report. Really, it's been a consolidation throughout the week after big gains the last couple of weeks, Eric, and really impressed on Wednesday after the metals caught a bid and the cartel really was unsuccessful in their smash post the FOMC minutes, and they really held steady for the day, pretty much unchanged on Wednesday. And then today on Friday, another big move, silver up nearly $1, gold up $20, above the big numbers of 1,424. Gold peaked above 1,400, couldn't quite hold it through the close, but basically closing at the highs just under 1,400. Silver, the big story, again up almost 4%, and it cleared 24 in the access market trading and closed just about at the week's highs and the month's highs, and I think it's about a 4 or 5 month high too. So once again, we had a similar trading in the markets today, Eric, that capping level breach in the access market and then short covering to the upside in the access trading.
Yeah, well, that speaks to that pattern that we were talking about as early as 3 weeks ago when we were looking at the Fridays. This being the third Friday in a row where the metals have closed very strongly. This being a blow-off, in fact, but it points to that entire thesis of what I've been calling and what Sinclair often calls the mercantile sense of what's going on in the market having shifted. And the traders who are in this day in and day out and have been trading for a long time kind of see these shifts very clearly and they position themselves accordingly. And that's why we were speaking about short sellers freaking out in the last couple of Fridays in our last reports. And this is yet another indication of that same kind of thing happening. And the trigger today most clearly was the housing number coming in way below expectations, and people looking around saying, gee, you know what? All this talk about tapering from the Fed, well, it's just a bunch of BS. And I spent some time in the write-up as well, too, analyzing the discussion of the minutes that were released on Wednesday for the previous month, and there was only one Fed governor of the voting board that actually was in favor of not supporting a continuing policy of generous easing. So there's been a lot of focus on non-voting members in the Federal Open Market Committee, jawboning, media appearances, and how the Fed has basically been flip-flopping consistently for the better part of the last 3 months. But when the bottom line is looked at, and then when you look at the fact that on a net basis, Treasury bonds are being sold by foreigners, and in June, we saw a decline of $40 billion of net purchases, so a decline of $40 billion for U.S. long bonds. There really is no way for the Fed to get out of this box. They'd have to continue to press on with quantitative easing. And they might, try to do a show of $10 billion of trimming as a quote-unquote tapering, but that really doesn't mean anything in the long term if they continue to have the program at $75 billion or whatever. Over the next 2 years, that's a heck of a lot of money. We're still talking about something that would push the balance sheet of the Fed closer to $5 trillion as opposed to the 3.7 or whatever it is right now. I forget off the top of my head. That, and then the other really interesting thing about this week's trading was that on Monday, Tuesday, and Wednesday, every single day in the access market, the thinly traded portion of the 24-hour period, the cartel was out trying to manage expectations downward, pushing precious metals down. And every single time, in particular that day when I came out with the article talking about the equities in the latter portion of that day, rebuffing the move, it's very clear to see that the entire sentiment and makeup of this market has done a complete 180. It's in bull mode now, folks, and it's going to continue. I mean, we will possibly see the cartel come in on late Sunday trading, early Monday morning, in an effort to cool things down after this explosive Friday, because that tends to be what they do. But all things considered, it looks like we're going to continue to move higher until that next line in the sand that they'll draw at that $25.25 silver, $26 silver, and higher prices with gold. And from there, once we blow past that, considering how tight the physical market remains, I expect we'll be talking about $30 silver not too long, maybe 2 weeks from now even. Who knows? I mean, we're in a very strong period when it comes to the seasonality for both gold and silver.
Yeah, I'd agree with the added point that I think there may be a little bit caution warranted or needed early in the week, as you mentioned, with the chance of a cartel smackdown or Sunday night or Monday, particularly with options in silver expiring on Tuesday the 27th. So I really expect a pretty staunch defense of around the 25 to 26 level, probably 25.50-ish. They're probably going to have quite significant resistance there. Especially, we've had a pretty massive move in a short time in silver particularly. We've moved from, about 18 on the lows now to over 24, so you're talking over a 33% move in just a couple of short weeks. So I think a pause is probably due, but I think we're both in agreement that it probably is likely just that, a pause, and then we could be on to much higher levels. But I think a bit of caution is probably warranted early in the week. We'll see as far as the options expiration on Tuesday.
And I would define pause in terms of days. I mean, the level of tightness in both physical gold and silver is just unprecedented. When you have GOFO going at negative rates for over a month at this point, and silver really, really hard to find in volume. I mean, people could buy it, but if you want to go and plop down $20 million to purchase silver, you're not going to be able to get your order filled for the better part of maybe even as much as 6 months. There's only 7 or so million ounces of gold on the COMEX inventory left. I mean, the level of COMEX inventories have been declining like a waterfall all year long, and it speaks to this continuation of supply being really, really tight.
Right, exactly. The wholesale market, the supply is still extremely tight, particularly in silver. We had JP Morgan again taking gold out of Scotia's vaults Thursday, reported today on Friday. Quick update on the wholesale side in silver. We finally had one of the major wholesalers have 90% come in live this week, and they had reduced prices by about $1 over spot, and that lasted about a whole 2 days, and they're totally wiped out, and everybody sold out again. Everybody, we jumped on it at SD Bullion, and we ordered up a bunch because we haven't been able to get it, and I'm sure all the other retailers did the same, and once again they're out, and the couple places that have it are about $1.50 higher than they're on delay. So, and again, that's just the 90%. The 100-ounce bars are still with the most popular ones anyways, like the Johnson Matthey Engelhard bars. They're out of stock across the board. There's only one supplier who's even selling it, and they're quoting like 8-week delays. Pretty much the same thing across the board for the Royal Canadian Mint bars, one of the other popular 100-ounce bars. Most of the wholesalers are totally out of them, and they're on delay. Delays are holding about steady with the Eagles and Maples, probably a week or two in both. A lot of suppliers actually have Maples live now, so that's actually eased up a little bit over the past week. I think demand was probably down a little bit early in the week as there wasn't too much action. It seems like everybody waits for the price to start moving to the upside and feel that they're getting left out to start making the bigger purchases. So it'll be interesting. I expect the wholesale market to remain tight really either way now, because if resistance in the 25-26 range gives way and we see a big pop to the upside, you're going to see a lot of sideline people have been sitting on the sideline rushing in to avoid missing out. And if we do have a couple dollar correction here, it's going to be a big pickup for demand as well.
And hat tip to SRS Rocco, who put out a good article on our site, and the chart was pretty telling in terms of the number of ounces of silver being sold by the U.S. Mint vis-a-vis gold. And that kind of ratio of nearly 500 to 1 speaks to the level of speculation being fired up amongst the most aggressive of people trying to pick the bottom. And that's a healthy indication, because it shows that there is money on the sidelines waiting to jump aboard the precious metals train. And the leading edge indicator of that is when you see silver being bought way quicker than gold, because silver declined far more than gold in the cartel takedown, and it's natural to see it rise faster, as we have been seeing in the last 3 weeks. All of these patterns are indicative of the market going through a healthy spike back after being brutalized. The same thing can be spoken of when it comes to the mining equities as well too, because they're performing at a faster rate than the bullion, and that's just to be expected.
And I want to take a moment here to put things in perspective a little bit as we talk about fundamentals in the gold and silver market and technicals of the recent trading. That's kind of all as a backdrop right now to the global geopolitical rapid escalation of Syria, and that could drastically escalate at a moment's notice. We have reports breaking tonight. We're recording this Friday night, and reports are breaking tonight out of CBS News that the Pentagon is preparing a cruise attack against Syria. Cruise missile attack. That's right. They're
not cruisers as in ships, but cruise missile attack.
Right, not cruise ships or not Tom Cruise. We're talking cruise missile attack.
Yeah. Well, hey, shoot, that's what we need to do. Send Tom Cruise in there. Yeah. He'll fix everything.
So we jest a little bit, but the situation is nearing a critical point, and it's really a game changer for the markets. And I mean, we're talking about the Middle East and the potential to escalate into a World War III situation with Russia backing Syria.
Yeah, and the sad thing is too is that when you look at this in the context of just what's going on in the marketplace and the stress in the financial system, the fact that the economy hasn't been able to get any traction after the Federal Reserve basically dumping in more gasoline than God, and the banking system, and nothing's to show for it in terms of real employment gains, and the middle class continuing to slide, et cetera, et cetera. When all these things happen, unfortunately, policymakers tend to say, well, let's go to war. That'll distract everybody. That'll ramp up the economy. And then meanwhile, we have this tension going on with the Chinese and the Russians jousting us, the United States and the Anglo-American Empire, in terms of supremacy when it comes to the global trading system's currency reserve system and trading system based on the dollar, with Russia hosting the St. Petersburg G20 meeting in September. And all these things are just kind of coming to a head, and the timing is such that it's really no surprise to see tensions on the rise on a geopolitical front. And frankly, the United States has had a long history of declaring lines in the sand where if such and such nation does such and such action, we will come in and do X, Y, and Z action. And that's kind of what's being set up here. It's been set up in the year and a half or so leading up to the destabilization, first and foremost in Syria, and now the civil war that's there. The United States has been funding Al-Qaeda. The people that were supposedly in a terrorist war that would not end in our lifetimes, according to Dick Cheney. We're funding Al-Qaeda to destabilize the Syrian government, so that according to divide and conquer principles, we presumably would be able to come in and have more say in terms of the geopolitical balance in Syria. But that ain't working out the way people in the Pentagon apparently have been planning, and Russia is making a line in the sand of their own. The whole chemical weapons attack in this week is fishy, to say the least. I mean, Assad doesn't have interests of his own to do something like that against his people, and particularly when that's set in the context of the United States saying all along that these guys are possessors of chemical weapons, and if they use them, we have to come in and clean up the mess and make sure that Assad is no longer a dictator hurting his own people. Where have we heard that thesis before? These things are cyclical. They happen throughout history. History rhymes, and unfortunately, the way things are looking now, it may in fact be an escalation. Even in the fog of war, things can happen that are not planned that can end up triggering war. And the tension is so high now that even that kind of scenario can happen. So that's certainly helping to contribute to buying in the precious metal space. It's not the primary reason why precious metals are moving higher, and even though the media will probably look at today's move and say, oh, that's what it is. It's what's going on in Syria that explains gold's rise and silver's rise. But unfortunately, we're in a really risky period, and it's good to hold precious metals for the ability to hedge against geostrategic risk and war as well.
Geostrategic risk, bail-in risk, market risk, the numbers are almost endless as far as the insurance. And insurance, I'd like to remind listeners again, insurance is only good if you own the insurance or hold it prior to the event. You can't go out and purchase insurance after your house is flooded or a tornado has hit your house or you've been in a car accident. You have to have the policy or hold the insurance prior to the event. So it's really going to be the same way with gold and silver, at least the way I see it. You're going to need to hold it in physical form before the event occurs. So I think both Eric and I are in pretty strong agreement that the sentiment has changed. We're definitely seeing bull market patterns, particularly on Fridays after we'd witnessed nearly repeatedly for 5 or 6 months major down days on Friday. The technical
roasting of the cartel too every day, Monday, Tuesday, and Wednesday every morning. That bounce back is very telling. The shorts are no longer in control of this market. It's a bull market.
Shorts are scared. They're no longer in control. So don't be surprised to see more disorderly moves to the upside, particularly with today's strong close in silver spiking up through 24 in the close. But again, a bit of caution is warranted on Monday and Tuesday with the options expiration Tuesday and the big 33% move just in the last couple of weeks. There's going to be a lot of paper traders who are going to take a few profits, I expect, around 25 or 26 and set up what we expect to be a short, brief pause before the resumption of the rally. So,
and also, too, we should point out that because 26 served as a bouncing platform for, 5 large bounces over the course of 2 years in silver, that was tremendous support for the longest of time. And then we broke through it when the cartel took everything down earlier this year. What is once large support ends up being resistance in the minds of traditional technical analysis traders. The cartel exploits that. A lot of people in our audience poo-poo technical analysis, and that's fine. But you have to understand that there's a lot of people with a heck of a lot of money that use it. And the Fed and J.P. Morgan and all of the cast of characters among the gold cartel fully understand this, and they exploit those technical patterns. So there's going to be a huge war when it comes to that level when $25.50 to $26 in silver. It'll be very interesting to see what happens. I would not be surprised to see it get past later next week, say maybe like Thursday, Friday. But time will tell.
Eric's exactly right, and that 26 level, normally from a technical standpoint, exactly that he's saying, that turns into pretty significant resistance now once it's been breached to the downside coming back up. The one caveat I'd throw out that potentially could be a game changer is what we've been expecting for a long time. Jim Sinclair's been expecting for a long time, and he came out with an alert just today, this weekend, stating that the bankers have now flipped long, and they have begun the process of manipulating the metals to the upside. So if that is the case, if the Goldmans and the J.P. Morgans of the world, the bullion bankers, have finally flipped in anticipation of the main move of the secular bull market, where, as Jim Sinclair says, basically return the most money to the fewest during the shortest period of time. If that is in fact at hand and the bankers have flipped to manipulating to the upside, that could change things quite dramatically. So I'll throw that caveat in as regards to the bankers and the manipulation.
Even so, it's not in the interest of the bullion banks to see prices spike super quickly, because that can destabilize interest rates, which in turn can unleash the bomb of the interest rate swap derivative market of some $500 trillion. That's the bomb that everybody and their dog is afraid of when it comes to international bankers And they realize that even though they're positioning themselves to be net long, it's totally within their interest to make sure that it's an orderly ascent, and periodically they will, in fact, in the paper markets, not in their gold physical accumulations that they're stockpiling privately in their own vaults, but in the paper markets, they will continue to come in and blast the heck out of things to try to push things down slower and in bursts and keep an orderly rise. So I read Sinclair's note, and I don't think he made that particular comment or that perspective within his overall thesis, and I suspect he'd actually agree with my comment, but I can't speak for him. But it's not in the interest of the bullion banks to see things rise really quickly, even if they're positioning long, and the same thing could have been observed when things were falling apart and they were pushing things lower. With the exception of the drive-by shooting days of things, as an example, April 12 through 15, where you have spike down lows, the decline did occur over a period of months. So likewise, we're not speaking about the blow-off top here in terms of when people are rounding the block trying to buy physical, and there's none physical to be had, and the equities go up 50% in a week, and so on and so forth. I don't suspect that that's the call that he's making at this point. I think he's just saying, once again, in so many words, that in terms of the mercantile sense of the market, there's a complete shift, and that we are in bull mode now. Things will accelerate a heck of a lot faster than most people anticipate, because the sentiment's still. And we even see that on our site. The comments between Monday and Wednesday were pretty bearish, leading up to what we saw later in the week.
Right. I don't think it'll take too much longer before the sentiment starts being fairly positive and excited. Definitely, I think once 26 is taken out, and for sure after we get through 30, there's going to be a lot of excitement come back into the metals market, because especially in silver, a move back through 30, in gold probably a move back through 1600. That's going to really signal a move back to the highs. No, it's not going to be overnight. It's going to take some time to work up there, but it's going to signal to everyone that the correction's over and the metals are back. So
that's exactly like what we were saying 2 weeks ago when we envisioned that it's entirely possible for silver to cross 50 by March 1st of next year. That's a huge move off of the lows, and we're talking about a reasonable amount of time. It wouldn't be analogous to the blow-off top kind of phenomenon that you see in ultra bull markets making their last stab. I mean, to just draw an analogy, back in maybe December of 1999, the Nasdaq was half the level that it had peaked by the time 3 months later it had reached over 5,250 or so, if my memory serves me correctly, and I don't have an internet connection right now, so I can't pull up a chart, and it's strictly by memory. But you had a 100% move in the span of about 3 weeks. That, folks, is a blow-off top, and that's not what Sinclair is talking about right now. When we have a blow-off top, God knows what the price of gold and silver is going to be like. I mean, that's well off into the future, unless if we have some kind of edict from central governments where they decide to close the banking system and revalue gold overnight, which is a possibility as well too. But in terms of where we're going in the not too distant future, it's just a shift in sentiment, and bulls are going to continue to come in, and people are going to not be in the market because everybody still is mostly bearish. I mean, the momentum indicators show that a lot of people have swung in terms of short-term money, but in the big picture, most people are not in this market.
Right.
And that's the bottom line. They're still bears. And that's what's going to surprise everybody, and that's what I think James Sinclair is speaking to.
And that's what's going to change over the next 6 months, I think. But
exactly.
All right, so for Friday, the 23rd of August, $24 silver and $1,400 gold. Not bad for looking back just a couple of weeks. So once again, we look forward to a pretty exciting week next week, hopefully just in the markets, not in the geopolitical frame, just in the markets. But thanks for tuning in once again for the Doc and Eric Dubin to the SD Weekly Metals and Markets.
SD Bullion.